Welcome, another week on the books. A lot of environmental and trail derails in the United States, so a long weekend is something that a lot of people need under this constant stress, and also something that the market needs to reassess what it is thinking about the future outlook about equity and fixed income. So with here in Minute Finance, we're going to see why investors probably should keep picking up fixed income instruments for the next cycle. So our basis and our analysis comes from yields, the spread of yields, as we talked in the last video. So yields are usually mean reverting. This means that yields tend to have dislocations. They usually are distributed normally. They're always a mean, but they tend to come back to that mean even though if they are in economic growth or there is an economic recession, usually at the end we go to the mean. And the yields have a direct relationship with earnings because as earnings go down or up, yields move proportionally. So it's a good parameter to see how earnings are doing. Yields are also an estimate of future growth. When we get the earnings per share, this is how analysts who are experts in their industries, in their sectors, come out with future projections of growth. And based on those yields, based on those earnings that they project, then we're able to see what these bright people and professional people are thinking of the future, and it gives us a perspective of how the future will look for the different industries. Also, yields are an estimate of risk on and risk off behavior. You can clearly see when yields are spreading based on a benchmark. For example, if you use the government yield curve as the benchmark and you see yields are spreading in corporates, in municipals, in high yield, then there is probably risk appetite. Or when they are contracting, the risk appetite is off because everyone just wants to go into safe assets. Also, yields are very useful for valuation purposes because of our point 2 of future growth. And also yields have a direct relationship with risk-reward ratios. That's why, of course, a AAA corporate bond pays less than a high-yield CCC bond because the rating profile and the credit research shows that it's probably impossible for a corporate AAA bond to default, but it's very likely for a high-yield CCC bond to default. So investors would rather go into the high yield, right? If we believe that in the markets, as risk goes up, our rewards goes up. So investors will claim a higher yield for higher risk. So that's why yields are so important. That's why we do our analysis based on the yields of both fixed income and the equity market. So if you see the S&P 500 for the last 10 years or the last 13 years has a return of 13.03%. It's extremely high because the mean of return in the S&P 500 is around 8% for the last 120 years. And the standard deviation of these returns is around 14.48%. For the last 13 years, historically, is around 12%. So for the last decade and 3 more years, in a low interest environment, we have seen an excess of returns with similar standard deviation. But this is only in a low interest environment. How, now that the Fed has raised rates at the highest pace ever, how are the markets going to react? I don't think we're going to continue to see the same trend. Now, historically, the S&P 500 earnings yield reached a record high of 15.5 and a record low of 0.79. And the median value, which is the key element here, is 5.47. That's what the median value across history is. So how does this come to our analysis? So earning yields, what we see, the S&P 500 companies, the S&P analysts have said that the EPS, so the earnings per share, is around 18.52. So the S&P 500 is trading at 18.52 of its earnings. So if we divide that over 1, then we get around an earnings yield of 5.4%. Now a T-bill, with a 3-month T-bill or 6-month T-bill, are very similar in their yields currently. It's at 4.91%. And there is no reinvest risk for treasury bills because that's what you're going to get at the end. Now, investment grades from the 1 to the 3 year currently at AAA or in the high rating category are yielding 5.38%. This is only 2 bips difference. It's a big change. Why? Because in investment grade, I will say that there is zero default risk because corporate balance sheets are not wary. They are still strong. There are no liquidity concerns in these companies, in the US at least, for AAA or high rating companies. So a 5.38% versus a 5.4% in the equity markets, an investor, if they were to be analytical, they'll pick the investment grade bonds because it's yielding the same amount of the equity markets, but with almost less standard deviation of those returns. And also high yield, if you really want to go there, is at 8.4%. But again, if you're only taking 300 bips in high yield, there is a big risk of default to there. But again, earnings yield in the equity market seems a little too low for what the other fixed income instruments are providing. And this is what we're talking. So I assume it's 5.39 or 5.4. As rates go up, which they might continue to go up, and cash just go down as we are entering in an economic, somehow sluggish part, valuations are going to go down and your yield is going to go down, right? Because your earnings going down and your discount rate goes up, well, your yields are going to go down, while in the fixed income market, yields seem to going to be constant, higher for longer. So in the long term, it doesn't make sense to go into the earning yields. And along with this 5.4, 5.39 has a 50% chance probably of going up or lower than this. So there is no guarantee. We can actually outperform the market maybe this year, it's 2023, have a great comeback, or we can severely underperform. So the risk is tremendously there. So why not just go into investment grades, which is yielding only 2%, 2 bips less than the earnings yield of the equity market without taking all that risk. Now, there's another prospectus. GDP growth annual in percentage for the last decade, but last year was 5.9, but we're coming from a recession, so it's a little skewed there. But from the last decade, from 2010 to 2020, we saw in the world, the average was 3% growth. But this is with interest rates in an all-time low, and also with energy markets being functional, with energy markets providing abundant resources at a good price. So now that we have the opposite, we have higher rates and energy costs are really high. I doubt that the world economy is going to keep growing at the same pace, which brings a lot of trouble for growth and equity markets. And the only way to see a great perspective, so for now we have to invest in fixed income markets because that's where we live. From a yield perspective, it makes sense. But in order for the world to actually keep this growth at a high rate environment and lower output is to automate. So sustain level of output growth with constant costs, right? And the only way to do it is through automation. So address the shortage of the labor market. Because I believe the labor market is what's really bringing the Fed Reserve very worried. It's coming, inflation is getting stick in all services and all elements. because of a shortage of labor market, because there is such a shortage of people to work that then wage growth has to keep up in order to attract talent, and because of that your costs also go up. And the best way for this to do it, even though it sounds like, oh, we don't need people, is to automate. One, because demographics, there is a big swing in demographics, not only here in the US but also in China. As your net migration goes lower and your birth rate goes lower, you're going to suffer in the future when you don't have enough people to work. Also, as we said, the wage growth is being problematic, and the only way to sustain growth for the next 10 years is to automate. So you need less people, but through automation you provide the same output with similar costs. So that's our perspective on the markets for the next year. So we believe from a yield perspective that the fixed income markets are the way to be, at least for the next 9 to 12 months. Thank you for watching, and I hope you found this video informative, and if yes, give us a like and subscribe.